Hello, my name is John Augustine, Senior Vice President of Business Development for WellNet. Today we'll briefly show you how we solve the healthcare cost problem different than our competitors. WellNet provides our clients insight into the cost drivers within their health plans and works with our clients to implement solutions leading to improved member health and compliance. Those two things translate to lower costs. Today we're going to hit on 5 topics in 15 minutes. And here's our agenda item. We'll quickly frame out the opportunity and talk about why the Affordable Care Act has created an environment that is favorable for partial self-funding and level funding, which are the 2 types of plans that WellNet offers. We'll talk about our approach, we'll talk about our reporting, we'll touch on our service model, and then we'll touch on the distinct differences between our chassis and those of our competitors. As we frame up the opportunity, I'd like you to ask yourself 2 very simple questions as it relates to fully insured groups. So if you're a client and you leverage a fully insured carrier for your health care, I urge you to ask yourself these 2 questions. Does reducing claims within my fully insured plan actually reduce cost? And does my fully insured carrier actually have my best interests in mind? Before I answer those questions, or as a way to answer those questions, I'd like to frame out the opportunity a little bit and talk about the medical loss ratio mandate, which was part of the Affordable Care Act. This medical loss ratio rule applies to the entire pool of business for every fully insured carrier. And that law created 2 different versions of itself, one specific to the pool of business that insurer plays in for groups of 2 to 50 employees, and a slightly separate version of that law based on the pool of business for groups that have 51 or more employees. So for you on the phone, if you're a group of 2 to 50 and you're a group of 51 plus, this law is slightly different, but it works the same way. Here's how it works. For the pool for groups that have 2 to 50 employees, the law states that of the entire premium charged by that insurance company to all the groups in that pool, 80% of the premium charged has to go out their door to pay claims. And for the pool that has 51 employees and more, for that entire insurance company, the law states that 85% of the premium charged to that pool by that insurance company must be used to pay claims. So the quick distinction is 80% of the premium has to pay claims in the 2 to 50 market, 85% of the premium has to pay claims in the 51 plus market. Now the logic behind this law was so that the insurance carriers cannot arbitrarily raise your premiums every year. Now, in order to raise premiums, the fully insured carriers must prove that their claims represented more than 80 or 85% of the premiums that they charged. Now on the surface that law sounds logical, but let's dig a little bit deeper. Most of the revenues for fully insured carriers come from fully insured premiums. These are insurance carriers at heart. They take a premium in exchange for insuring risk. The fully insured carrier's profits are part of that premium. So simply put, to raise profits, they have to raise premiums. But as we just talked about, the medical loss ratio law states that the carriers cannot raise premiums unless the claims represent more than 80 or 85% of that premium. And that means that if the carriers want to make more money, they need your claims to go up. Now, I don't think that the law set out to accomplish that. Certainly, I don't think anyone wants your claims to go up. But from a pure financial perspective, the insurance carrier cannot make more money on you unless your claims go up. What that means is that there's really zero incentive for the fully insured carriers to actually manage claims costs. Let's look at it from their perspective. If they reduce claims costs for their entire pool of business, whether it be for the 2 to 50 pool or for the 51 plus pool, that would mean they'd have to lower their premiums, which means lower revenues, lower profits, and a lower share price. And most of the fully insured carriers today are publicly traded. And with the mergers and acquisitions that are going on, 5, 10, 15 years from now, most of them will be publicly traded. And that's a lose-lose-lose proposition for Wall Street. Wall Street requires higher revenues, higher profits, higher share price. Partially self-funded plans don't have to play by these rules. And the beauty of partially self-funding is that clients only pay for the health care their people consume. And that means if you consume less health care, you'll pay less in health care claims. And that's a direct correlation. Improve your people's health, pay less for health care. This picture in our mind represents sort of the concept that I just talked about. If you, Mr. Client or Mrs. Client on the phone today, have a very healthy company, a company whose loss ratio is 50%, you don't get this money back. The only time the fully insured carrier has to give any money back to the companies in that entire pool is if the entire pool of business ran better than 80 or 85%. And in that case, they would take that extra money and divvy it up equally amongst all the companies in that pool. So just because you today are a healthy company and you have taken the right steps to improve your members' health, that does not translate to lower cost. As a matter of fact, as you've seen, typically your renewals go up every year, regardless of what your loss ratio was. Partially self-funded plans, on the other hand, span the gap between employers and employees. What WellNet's built is a partially self-funded arrangement, and that's what this safety net is. This is stop-loss insurance. I won't get into the details today, but all of our plans include stop-loss insurance. All of our plans include all of the data made very easy for you to understand through our portals. And we use that data to predict the future. If we could tell you, here's what you're going to spend this year, next year, the year after, if we don't change some behaviors, if we don't help you understand those cost drivers and manage those cost drivers. When you've got that data, WellNet partners with you to think about, consult, and create the programs necessary to better manage that risk. If you think about it like this, perfectly healthy people come to work every single day, and they don't cost you anything from a workers' comp perspective, and they're extremely productive. Sick people miss work, and they're not that productive at work, and sick people cost your health plan a lot of money. So in very simple terms, having a population of very healthy people will directly correlate to lower healthcare costs if you're partially self-funded. Now, WellNet's self-funded plan was built on 4 key pillars. The first is stop-loss insurance. Even large companies that self-insure should buy stop-loss insurance, but certainly small companies must as a way to manage their pocketbooks. And all of WellNet's stop-loss carriers are A-rated stop-loss carriers. The second pillar is a network. The 2 core networks we work with today are Aetna or Cigna. On the pharmacy side, the network we use is CVS Caremark. And most importantly, all of WellNet's plans come with integrated population health management, which is a combination of those predictive analytics, helping you understand the future, and then working with you to develop the appropriate digital and live health coaching programs, perhaps through the use of biometric screenings and incentives to, again, improve member health, drive down claims, and lower cost. Now, in short, the key to lower costs and to reduce costs is through the management of risk, because, again, perfectly healthy people do not cost anything from a healthcare perspective. Now, here's on a single slide how WellNet does it. We use our software to stratify the risk, predict the future, and provide every stakeholder the reports necessary to have a strategic dialogue about what programs might be relevant. Now, while you don't have to do anything that I'm about to describe here, most self-funded clients choose to implement wellness programs and health coaching programs because it improves members' health and lowers claims. That said, it is hard to get people to change their behavior, so the use of incentives will drive that lasting behavioral change. And because WellNet's got our own piece of technology that we use, we have the ability to integrate all of the data, automate most of the process of member engagement, and connect the right people with the right care at the right time. Now, for those of you on the phone or listening to this webinar, you'll have access to all of your data through a reporting portal that we make available to you. And your members will also have access to all of their own relevant healthcare statistics and data. They'll even have a mobile application so they can access everything on the go. Now here's a wonderful case study of how WellNet was able to save a group in Florida a lot of money over a 2-year period. This group went from 74 employees to 96 employees from 2013 to 2014. And their fully insured renewal was $908,000, which was an increase of $349,000. Now WellNet took a look at this group's information and provided them a rate guaranteed of $580,000, which was a savings of $328,000. Now this group grew again during the time we had them, from 96 employees to 155. We issued that group a renewal that was $971,000. Just to make sure our price was in check, their agent took this group out to bid, and the fully insured market confirmed that the best rate they could find for a comparable plan design was $1.6 million. So in a 2-year period, WellNet was able to save this group about $969,000. That's really the power of self-funding. Now, self-funding is not right for everyone. Those fully insured pools serve a purpose. But when you think about those fully insured pools, they're really offering average rates to all the groups in that pool. And that tells me that 50% of the companies in that pool are probably better off being self-funded. But the contrary is also true. 50% of the groups in that pool are probably benefiting from being in that pool. Let's touch on our service. WellNet's got a bunch of professionals that can spend time in the field educating you, working with your agents. From an implementation perspective, when we implement a group, all of our groups get a dedicated implementation manager that acts as your single point of contact until your plan's running perfectly smoothly. And at that point, we will now transition it to a dedicated account manager who will now act as your single point of contact for all things service. WellNet provides both direct phone numbers, email addresses, and even cell phone numbers to all of our support staff, all the way up to the CEO of the company. We're very accessible. Beginning in 2016, WellNet's account managers provide all of our groups with a mid-year review, which helps you understand exactly what's happening and helps you plan for the next year. Now, all of our groups get daily, weekly, and monthly reporting, so that's available through our portals. But these special mid-year reviews are put together by your WellNet account manager and will be presented around the 6-month mark. Typically, renewals are released about 60 days in advance of your renewal date, although we can make arrangements to have them released at approximately 90 days out. From a quoting perspective, we really have 2 options, the first of which is the submission of historic claims data. The objective in submitting that data is really to allow our stop-loss vendors to gain a very clear understanding of both your aggregate claims risk and any specific member risk. So we're trying to get our head around what are the total claims going to be, and are there any catastrophically ill patients? We can work through it, we just need to understand. Typically what clients provide us are monthly claims for as far back as possible and the diagnosis and prognosis of any catastrophically ill patients. If this is not an option, we can still offer underwritten rates, but we would need employees to log on to a secure online portal and complete a brief medical questionnaire. And that data is never shared with you. It comes directly to WellNet and is shared directly with our stop-loss providers. There's a few different ways that can be completed online, and WellNet does also accept paper forms from any of our competitors. Here's a listing of our differentiators. And these differentiators are specific to other level-funded products in the marketplace. WellNet returns 100% of the claims surplus within our level-funded plans. In the unlikely event that you terminate with us, we still give you back 100% of the surplus. So you should feel safe moving to WellNet. From a network perspective, we can offer you both the Aetna and the Cigna network, as I mentioned a moment ago. From a stop-loss perspective, we shop the stop-loss on your behalf with several A-rated carriers each year. But we also allow our broker partners and our clients to secure their own stop-loss. And that's a wonderful bit of flexibility at renewal time. From a customization perspective, WellNet allows you to completely customize your plan design down to 10 enrolled lives, which is also our minimum group size. So complete customization is available at no additional charge. And funding options. While I will not go into detail right here, we obviously offer level funding as one of our options, but we do not require that clients level fund their healthcare plan. We do offer a quote-unquote pay-as-you-go model, which allows clients to pay their claims as they come in rather than level funding. And most importantly, while I haven't gotten into a lot of detail today, all of our plans come with integrated population health management. As the steward of a self-funded health plan, whether it be level funded, alternate funded, or traditionally self-funded, as the steward, it becomes important to support your people and to foster an environment of good health, a culture of health and wellness. Because again, as I mentioned, a perfectly healthy population costs next to nothing in healthcare costs. So as a partially self-funded employer, it's important that we try to focus on improving health. As one of the category leaders in providing innovative healthcare delivery, WellNet gives our clients the data, tools, and people necessary to make better, more informed decisions regarding their healthcare options. We do that through our level-funded health plans and the integrated population health management that I touched on. Thank you all very much for your time today. Please reach out to us anytime to schedule one-on-one time with members of our team. Thanks again.